much, but I give directly the floor to our next speaker, Mr. Graziano Crema, who is Head of Regulatory Department, Corporate Investment Banking, BBVA. We're especially grateful to him as he accepted a late invitation to replace another speaker who withdrew. We also carries this heavy burden of being the only panelist who actually works for a large universal bank. Mr. Crema, the floor is yours.
Thank you, Mr. Chairman. Dear members of the Econ Committee, distinguished guests, ladies and gentlemen, thank you very much for your kind invitation. I'm very honored to be given the opportunity to talk to you on this subject, not only on behalf of my institution, a large universal Spanish bank, but also as a member of the European Banking Federation's expert group on banking structural reform. The purpose of my intervention is to try to explain why the Commission's proposal on bank structural reform is unnecessary and unjustified. I plan to talk about three main issues: the banking regulatory reform agenda, the role of universal banks, and some micro-level impact of the proposed text. I would like to first highlight the wide range of measures already taken or under discussion by the European and global regulators, which aim to strengthen the financial system. Over 40 financial reform initiatives have already been adopted since 2008. Most prominent are the landmark capital, leverage and liquidity package, and the Bank Recovery and Resolution Directive, which already provides the power to bank regulators to change a bank's structure in order to ensure financial stability and resolvability. Moreover, initiatives have been taken at a global level to strengthen the risk framework of derivative markets and to review the trading activities framework. Additionally, the development of a minimum requirement for total loss absorbing capacity for cross-border globally systemic important banks will further address the issue of too big to fail for such institutions. Finally, the creation of the European supervisory authorities and the single supervisor for the Eurozone marks a shift in the approach taken to banking supervision, with supervision becoming more centralized, more intensive, more effective, and more resolute to take firm enforcement actions. Secondly, allow me a few words on universal banks. Universal banking is a strength of the European banking system, and research undertaken by the European Central Bank has shown that the income diversification arising from it places broad-based universal banks in a better position to support their corporate and SME customers during economic downturn, making universal banks a key element for the development of the European economy. The universal bank model has proven to be one of the most resilient in the recent financial crisis. As the IMF says, the fact that many smaller banks were bailed out during the crisis suggests that size restrictions are not a panacea. It should be reminded that universal banks not only provide services to the retail and SME segment, but are the main generators of liquidity and associated services for the European financial markets. Furthermore, as the ECB pointed out in its opinion on the Commission's proposal, it is fundamental to preserve the market-making activities in order to maintain or increase asset and market liquidity, moderate price volatility, and increase security markets' resilience to shocks. The ECB also highlights that market making is essential for financial stability, implementation and smooth transmission of monetary policy, and the financing of the economy. However, as it is written, the original proposal will negatively impact the incentive for universal banks to undertake market-making activities. This will reduce market liquidity for instruments like corporate bonds, which will make financing more difficult. Impairing the role of banks in capital markets will undermine the capital markets union as an alternative for financing SMEs. The original proposal on bank structural reform is therefore at odds with the European job and growth agenda and the goal to revitalize the long-term financing. Before I move on conclusion, I would like to highlight some specific impacts that will negatively affect separated entities. The trading entity will experience increased funding cost. A March 2014 Banque de France study estimates the increase in funding cost to be in the range of 220 basis points, 2.2%. Such increase would reduce the capacity of providing market-making services. As highlighted in this ECB opinion, separation does not by itself solve the too-big-to-fail issue, and consequences of mandatory separation would be a concentration of client-oriented services in the hands of a few number of large or larger market players, increased competition from non-EU institutions, and a reduction of the liquidity in the European financial markets. Additionally, in consideration of the particular requirements of retail and SME customers, in particular tailor-made transactions, the core credit institution would see its ability to offer products and hedge its risk substantially decreased, hampering the envisioned functioning of the SME market. Additionally, the cost of funding for the core credit institution may also increase due to the reduced liquidity of the financial markets. In conclusion, I suggest a thorough review of the current proposal. This review should take in close consideration the profound ongoing transformation of the regulatory and supervisory banking frameworks, and should seek alignment with the European Commission's goals to promote sustainable growth and ensure long-term financing of our economy and the further development of a European Capital Markets Union. Thank you very much.
We thank you, Mr. Crema.